Which broker to choose and what type of account should you open? Well, this is the most common question I get, and even though we've covered a lot of material and different ways to participate in the market, it's still not going to justify you rushing in to open an account and then start using real money. Only after you have your personal financial situation in order, you understand the risk, you know how to manage those risks, and maybe after you've spoken with a licensed financial advisor to make sure that you are on the right path to meet your future financial goals, then you can start to think about opening an account. But before you open an account with one of these big name popular brokers, I highly recommend that you participate in your employer's 401k program first, if they have one. Now remember, way back in an earlier lesson, I mentioned that if you weren't quite sure what you should do, whether you should invest, swing trade, or day trade, you should invest first, because investing is going to secure your financial future so you don't have to work when you're 65 years old. Swing trading and day trading is really just done to supplement income. And yes, you can make it your full-time job if you dedicate the time to learn, but you would still want to contribute money every month to a long-term portfolio so you don't have to swing trade or day trade forever. You'd want to retire at some point. So start with a long-term portfolio. And the best way to start is with your employer's 401k program if they have one, because a 401k account can make savings for retirement automatic and effortless, which also has some great benefits as well. Since a 401k is through your employer, a certain dollar amount or a percentage of your paycheck is going to go directly to your 401k account before taxes are taken out. So that's a good thing because, number one, it's going to force you to save for retirement because it automatically comes out of your paycheck. So you don't have a chance to spend it. And number two, since it comes out before taxes are taken out, it's going to lower the amount of income that you're taxed on when it comes tax time. So you'll be able to save a little bit more on your taxes. Another huge benefit of 401ks is oftentimes employers will match up to a certain percentage you put into your 401k account. That's free money. Are you going to say no to free money? Because I definitely want it, which is why it's recommended to contribute at least the same amount that your employer is willing to match. Now, if your employer doesn't offer a 401k, you can open up an account with a broker that is called an IRA, which stands for Individual Retirement Account. This is going to be the next best option, which we'll go over later in the lesson. Now, there are lots of options when it comes to choosing a broker, and every broker has something that differs from the other, and depending on how you would like to participate in the markets, whether it's long-term investing, swing trading, or high-speed day trading, that should influence the type of broker that you choose. There isn't really a broker out there that's a one-size-fit-all for everyone. Even though some brokers try to have something for everyone, they still lag in some areas. So out of the three styles of participating in the market, such as investing, swing trading, and day trading, these are what I personally recommend. Now, they all have advantages and disadvantages, so I encourage you to go to their website and research what all they have to offer and figure out what you value the most. Now, my placement of these brokers inside these categories aren't strictly for that type of category because it also depends on the strategy and the style that you use and the type of stocks that you are trading. So this can be moved around a bit, but generally these platforms work best for the categories I put them in. Now, you don't have to choose any of these. These are a personal opinion. You are free to search and choose whatever you want. Just be sure that you choose a broker that is designed to work with the strategy you are using. You don't want to be day trading on something that is designed for investing because day trading requires speed, and an investing platform is not designed for speed. It's designed for research and analyzing. So an investment platform is going to be too slow. Your broker needs to suit your strategy. Don't suit your strategy around the limitations of your broker just because you don't want to use anything else. Now, when you are filling out the forms to open up an account with a broker, one of the questions they're going to ask you is what type of account you would like to open, with options being a cash account, a margin account, or an IRA. Each account has its advantages and disadvantages, so it really depends on what your needs are. We'll start with the cash account here, and I've listed the 4 most important things to know about cash accounts. The first is all transactions must be made with available cash. So what that means is that if you have $5,000 available in your trading account, you can only purchase $5,000 worth of stock. Makes sense, right? Now, this $5,000 is what is called your buying power. It's the amount of money that you have available to purchase stocks with. And the cool thing about cash accounts is that there is no PDT rule. Now, if you remember, the PDT rule states that if an investor has less than $25,000 of value inside their account, then they are limited to making only 3 day trades per every 5 business days. But if you're using a cash account, you can make as many day trades as you want if you have below $25,000. But there's a catch. Once you have sold a position, you have to wait for those funds to settle, which takes 2 days. This is what is commonly known as T plus 2. It's trade date plus 2 days. So let's say that you have $5,000 in buying power to trade with, and on Monday you buy $5,000 worth of stock. For example, and we'll make it really simple here for math's sake, you buy 1 share at $5,000, then a few minutes later you sell that 1 share at $5,100. Well, on Tuesday, if you were to log into your broker wanting to make another trade, well, you couldn't. Your buying power will be 0 because you have to wait 2 days for the trade that you made on Monday to settle. So on Wednesday, when you log into your broker, you will see that you have $5,100 in buying power because of the trade you made on Monday, and it's finally settled. And the last thing about cash accounts is that you cannot short stocks while trading inside these accounts. So if you plan to short, you need to open up what is called a margin account. And here are the main things to know about margin accounts and if it may be right for you. If you open a margin account, you are actually able to borrow money from your broker to increase your buying power using your cash or held positions as collateral. Now, a lot of professional traders do this because it allows them to purchase more stock than what their account is actually worth. So when you open up a margin account with your broker is going to give you what is called leverage. And United States brokers are going to give you either 2-to-1 or 4-to-1 leverage. So here's an example of what that means. Let's say that you open up a margin account with $5,000 and your broker offers you 2-to-1 leverage. This means that for every dollar in buying power you have, they will match it with $2. So if you have a $5,000 account, you actually have $10,000 in buying power. Let's say that you opened an account with $25,000 and your broker offers you 4-to-1 leverage. This means that instead of having $25,000 in buying power, you're now going to have $100,000 in buying power. Now, the broker lends you this extra buying power in exchange for interest. So if you tap into this extra buying power, then your broker is going to charge you a certain percentage of interest for using it. Now, this is where you have to be extremely careful. This leverage sounds wonderful. If you had $25,000 and you're able to buy $100,000 worth of stock, well, that's just going to skyrocket your gains, right? Well, you have to realize that it's a double-edged sword. Not only can it maximize your gains, but it can maximize your losses to a point where you may end up owing your broker money. If you had a $25,000 account and you used all $100,000 of it in leverage on a stock purchase and you lost $50,000 on that one trade, then not only did you lose your $25,000, but now you owe your broker $25,000. So that could be very dangerous. All right, there's also a lot of rules with this, and you have to abide by them when borrowing money from your broker. You have to maintain certain thresholds of account balances. Otherwise, you'll end up in violations called margin calls. Whenever you open a margin account, you have to sign an agreement with your broker saying that if you borrow money and you end up taking a bunch of bad trades losing their money, your broker has the right to liquidate your account. So if you are new and you decide to open a margin account, I strongly suggest you never actually use the extra buying power they give you and only trade with the actual amount of cash that you have in your account so you don't get caught up in a bunch of margin call mess. Now, to be able to open a margin account, there will be a minimum deposit. Now, this differs from broker to broker, but the minimums for all United States margin accounts is $2,000. The reason they have this is for collateral. Right? If your broker is going to allow you to borrow money, they want a certain minimum in your account for you to do so. Now, another great thing about trading in a margin account is your trades settle immediately. So unlike where in a cash account where you sell a stock, you have to wait 2 days to be able to use that money again, inside a margin account, once you sell, you can immediately turn around and use your available buying power to purchase a stock again. So let's say that you had an account balance of $25,000 and you bought $25,000 worth of stock and then sold it at 1 p.m. You can turn around 10 minutes later and use that same $25,000 to make another trade. And you can do this over and over and over however many times you want, except for one rule. Inside a margin account, you have to have over $25,000 in order to make unlimited day trades. If your account balance falls below that $25,000, then you are restricted to making 3 day trades in a rolling 5-day business period. And the last thing that you are able to do is short stocks inside margin accounts. Being able to short stocks is a great feature, especially for day traders, because you can make money when stocks are going up and you can make money when stocks are going down. So it increases your opportunities in everyday changing markets. Now, the last account type is the IRA. IRAs are the best account types if you plan on long-term investing for your retirement savings. There's 2 different types of IRAs, and they differ from each other in the way they calculate taxes. So inside a Roth IRA, your account will grow tax-free. You don't have to report the profits inside a Roth. So if you make money during the year from either buying or selling stocks or collecting dividends, you won't be taxed. That's because you pay income tax on your money before contributing to the Roth. For example, if you work a 9-to-5 job and every Friday you get paid, well, every Friday your check already has taxes taken out of it and you get what's left over. Now, that money that you have has already been taxed before you put it into the Roth. So not only will your account grow tax-free, but you also won't be taxed when you start withdrawing money in retirement. But there's a limit to how much you can contribute to a Roth account each year. So as of 2019, the max you can contribute is $6,000 per year. So let's say that you open a Roth IRA for the first time today. The max you can contribute is $6,000 for this current year. Only until January 1st, the following year, you can contribute another $6,000, where you'd have to wait until the next year or the next January 1st to contribute more. Now, traditional IRAs allow you to deduct your contributions in the year that you make them. So let's say that you can contribute $6,000 to your traditional IRA for the current year. And you also have a 9-to-5 job in which you made $30,000 that year. So when it comes time to do your taxes, instead of being taxed on $30,000 that you made from your 9-to-5 job, you're going to be taxed on $24,000 instead, because you contributed $6,000 of that money to your traditional IRA, which would be deducted from your total income. So that's pretty cool. But when you go to withdraw your money in retirement, you're going to be taxed on those withdrawals as ordinary income. Now, I'm not a tax expert or financial advisor, so I strongly recommend that you either do more research to know more about these account types to figure out which one is going to be best for you, or you seek out a licensed financial advisor to help you with setting something up that will best fit your specific needs. All right, so I hope you all learned something. Thank you so much for watching.